Understanding your 401k investment options. Your 401k is likely one of the biggest tools you'll use to build wealth for retirement. In fact, for most Americans, it's their single largest source of savings outside of Social Security. But here's what most people don't realize. It's not enough to just put your money into a 401k and hope for the best. The real question is how that money is invested. Are you too aggressive and risking a big loss right now before retirement? Or are you too conservative and missing out on the growth you'll need to make your money last? Most 401k plans come with a long list of investment options: stock funds, bond funds, target date funds, and for many people, it almost feels overwhelming. But making the right choices could be the difference between a retirement that feels secure and one filled with financial stress. So how do you know which investments are right for you? Hi, I'm Josh Bliss, financial advisor and founder of Gateway Capital Management, now proudly under Balboa Wealth Partners. And today, we're recording from beautiful Montana. We help retirees and pre-retirees simplify their investments, reduce taxes, and create a plan for lifetime income. And in this video, we're going to break down the most common 401k investment options, how they work, and what to consider when building a retirement portfolio that fits your goals. Before we jump in, make sure to like this video, subscribe to the channel, and drop a comment below if you've ever felt unsure about where your 401k contributions are actually going. What's inside a typical 401k plan? When you log into your 401k account, you might see a long list of investment choices. For many people, it feels overwhelming, almost like trying to order dinner from a 10-page menu without knowing what any of the dishes are. Here's the good news. Most 401k plans are built around a few key categories of investments. Once you understand them, it becomes much easier to make smart decisions. The main options you typically see include stock funds, sometimes called equity funds, bond funds or fixed income funds, target date funds, and sometimes stable value funds or money market funds. Each type of fund serves a different purpose in your portfolio. Stocks help your savings grow over time. Bonds provide more stability and generate income. Target date funds automatically adjust your mix of stocks and bonds as you get closer to retirement. The challenge is figuring out how much of each you should own. That depends on your age, risk tolerance, and how soon you'll be needing to draw income from your 401k. Stock funds, the growth engine. Stock funds are designed to grow your wealth over the long term. They invest in shares of companies, and over time, these companies can grow in value, boosting your portfolio. Here are the common types of stock funds you might see in your plan. Large cap funds. These focus on big established companies like Apple, Microsoft, and Johnson & Johnson. Mid-cap and small-cap funds. These invest in smaller companies which can offer higher growth potential but also come with more risk. International or global funds. These give you exposure to companies outside of the US, which can add diversification to your portfolio. In your early working years, it's common to have a larger portion of your 401k in stock funds because you have time to ride out the ups and downs of the market. But as you approach retirement, keeping too much in stocks can be dangerous. Real life example. David, age 62, kept 90% of his 401k in stock funds because they've always worked for me. When the market dropped 20% in a single year, David's portfolio took a major hit just as he was planning to retire. That's why it's important to balance growth with protection as you get closer to needing your savings. Bond funds, adding stability. If stock funds are the growth engine, bond funds are like the shock absorber. They help smooth out your portfolio and generate a steady stream of income. When you invest in a bond fund, you're essentially lending money to governments or corporations in exchange for interest payments. Here's what you need to know about bond funds in your 401k. They don't grow as quickly as stocks, but they generally are less volatile. Bond funds can help protect your savings during stock market downturn. Example, during the 2008 financial crisis, retirees who had a mix of stocks and bonds saw smaller losses than those who were 100% invested in stocks. The bonds in their portfolios help cushion the blow, allowing them to avoid selling investments at a loss to cover expenses. As you near retirement, increasing your allocation of bond funds can provide more stability for your withdrawals. Target date funds, the set it and forget it option. If you've noticed a fund in your 401k with a year and its name like Retirement 2030 or Retirement 2045, that's a target date fund. Here's how they work. You pick the fund with the date closest to when you plan to retire. The fund automatically shifts from stocks to bonds over time. Early on, it focuses on growth. As you get closer to retirement, it becomes more conservative. For many people, target date funds are appealing because they simplify the process. You don't have to worry about rebalancing or adjusting your allocation every few years. But there's a catch. Not all target date funds are created equal. Some are too aggressive as you approach retirement, while others are too conservative and don't provide enough growth. They're not a one-size-fits-all. It's important to understand what's inside the fund and whether it matches your risk tolerance. Stable value and money market safety nets. These are the most conservative options in your 401k. Stable value funds aim to protect your principal while paying a modest interest rate. Money market funds invest in short-term, low-risk assets and are often used as a temporary spot for cash. These options can give you peace of mind, especially if you're nervous about market volatility. But there's a trade-off. The returns are very, very low, often not even enough to keep pace with inflation. There may be a place in your portfolio if you're very, very close to retirement or if you need liquidity for an upcoming purchase, but they shouldn't make up your entire investment strategy. 6. How to choose the right mix. Here's the key takeaway. Your 401k investment mix should reflect your stage of life, goals, and tolerance for risk. If you're younger and still building wealth, you can typically afford to have more of your 401k in stock funds for long-term growth. As you approach retirement, you want to gradually shift towards more bonds and conservative investments to protect what you've built. Even in retirement, don't abandon growth entirely. A portion of stocks in your portfolio can help outpace inflation and make your money last over a 20 to 30-year retirement. Real life example. Susan, age 59, reviewed her 401k and realized her investments were still in a growth mode allocation, 85% stocks and 15% bonds. With retirement only a few years away, she worked with a financial advisor to rebalance her portfolio to a more balanced risk, reducing her exposure to big losses. The goal isn't to guess where the market is going, it's to build a portfolio that supports your income needs and gives you peace of mind as you transition into retirement. So let's step back for a moment. Your 401k is likely one of the most important pieces of your retirement plan. For many people, it's their largest pool of savings, and yet most never take the time to truly understand how their money is invested. Maybe you chose your investment options years ago and haven't looked at them since, or maybe you picked a target date fund and assumed it would handle everything for you. But here's the reality. The choices you make inside your 401k today could determine how secure and confident you feel in your retirement tomorrow. The right investment mix isn't about being overly aggressive or overly conservative. It's about finding the balance between growth and protection so your savings can provide the income you need and withstand the inevitable ups and downs of the market. And this isn't something you have to figure out on your own. If you're within 5 to 10 years of retirement or already retired and you want to make sure your 401k is properly aligned with your goals, let's talk. Click the link in the description below to book a free consultation. I'll help you review your current investments, identify potential gaps, and create a strategy to make your savings work as hard for you as you work to earn them. Retirement doesn't require guesswork, it requires a clear, thoughtful plan. One designed to protect what you've built and give you confidence in the next chapter of life. Thanks for watching, and if you found this helpful, don't forget to like this video, subscribe to the channel, and share it with someone else who's thinking about their 401k.